All right, welcome to AI Explains ICT. In this video, we're diving into the core content from Month 4, Episode 6. You're definitely going to want to grab a notepad for this one, because we are about to pull back the curtain on a super subtle but incredibly powerful pattern, one that could totally change how you look at market turning points. Okay, so let's jump right in. Take a look at this daily chart. It's the British pound versus the US dollar. I mean, you can see some huge moves here, right? Massive rallies, big drops. But what I really want you to focus on are the peaks and the valleys. You know, those major turning points where the whole trend just flips on a dime. So the big question is, what's really going on at these major highs and lows? You know, what are the patterns that keep showing up? See, most traders, they're trained to look for one very specific thing, a big, dramatic, super obvious sign of a reversal. But as you're about to find out, the real story, well, it's often a lot quieter. Let's start with something you've probably seen 100 times, the classic fake-out. In the world of ICT, this is what's known as a turtle soup pattern. You know the drill, right? It's that textbook move where price just smashes through an old high or an old low, grabs all the stop losses sitting there, and then, bam, it reverses with insane speed. Now check this out. On the left, you've got that classic turtle soup we just talked about. Price runs the stops above that old high, and then it just collapses. It's clean, it's powerful, for sure. But here's the thing. It's not the only way the market unloads its positions. Now look at the chart on the right. See that? It's a reversal, but it happens without that crazy dramatic new high. And this is where things start to get really juicy. And that really brings us to the core question of this whole video. What if? What if you could spot a major reversal before that final explosive spike happens? What if the institutional footprint, the smart money's moves, was visible in a totally different way? Well, that's what leads us straight to this concept of the rejection block. Okay, let's get into the nitty-gritty of the bearish rejection block. Think of this as a super powerful distribution pattern. It gives us a much more nuanced view of how the smart money is actually selling into a rising market. It's all about reading the real story, not just the obvious stuff everyone else is looking at. So what exactly is a bearish rejection block? Well, it's a swing high, and you'll usually see these long upper wicks. But here is the absolute key, so listen close. The main event isn't price smashing above the highest wick. No, it's all about price running the liquidity that's sitting just above the candle bodies, you know, the opens and closes. That's where the real institutional action is. This diagram right here makes it super easy to see. Those long wicks, they're basically there to grab your attention, right? They make it look like there's resistance up there. But the real magic, the key, is the zone between the very top of that wick and the highest open or close of the candle bodies. That whole area, that's your powerful resistance zone. So how do you actually draw this on your own charts? It's pretty straightforward. Step 1, find a swing high with some obvious long wicks sticking out. Step 2, mark the absolute highest point of those wicks. Step 3, and this is the most important part, so don't miss it, find the highest open or close among the candle bodies within that swing. The space between those two lines you just marked, that's your bearish rejection block, and you can treat that whole zone just like a bearish order block. Okay, let's look at a real-world example. You see this swing high here. Price rallies up, it forms these long wicks, then, a little later, it trades back up, but by close attention to where it stops. It just pokes its head slightly above the highest candle body, grabbing that liquidity, but it never goes back up to challenge the absolute high of the wicks. This is that subtle distribution ICT is always talking about. And look what happens right after, a major drop. Now, of course, this whole idea works both ways. The exact same logic, just flipped on its head, is what helps us spot powerful accumulation down at market lows. So let's take a look at the bullish rejection block. So you've guessed it, the bullish rejection block is a price low with long lower wicks. And in this case, the smart money isn't sitting around waiting for some dramatic crash below the lowest wick. Nope. Instead, they're busy accumulating their positions by running the sell-side liquidity that's sitting just below the candle bodies. It's like a surgical strike on the opens and closes, not a full-on assault on the wick lows. And here we have the diagram for the bullish version, just to make it perfectly clear. Once again, those wicks are the first thing you see. They're drawing your attention to a potential turning point. You framed a zone from the absolute bottom of the wick up to the lowest open or close of the candle bodies. That entire range, that becomes your high probability support zone. You can think of it as a bullish order block. And check this out. Here it is in action during a massive accumulation phase. The market makes this swing low, you can see the long wicks clearly. Then price dips back down, and it trades just below the candle bodies, clearing out that layer of sell stops. See? It doesn't need to make a new dramatic low. This subtle accumulation is all it took before a huge rally just blasted off. Okay, so we've identified both the bearish and the bullish patterns. That's great, but how do we actually use this stuff in our day-to-day analysis and trading? Let's go ahead and bridge that gap from just theory to real practical application. The thing about rejection blocks is that they're just incredibly versatile. For one, you can use them to pinpoint high-probability entry zones. Just treat them like you would an order block. Or let's say you're already in a trade. Well, they make for incredibly precise targets to take your profit. But maybe most importantly, this whole concept helps you see the institutional hand at play, even when that classic stop-run pattern we all look for never even shows up. You know, if you only take away one single thing from this entire video, please let it be this quote from ICT himself. Don't always demand that price gets below the wicks. It's really the bodies of the candle that the closest thing to institutional understanding you're going to get. That says it all. The opens and the closes, they tell a much deeper story than the crazy extremes of the wicks. So, I'll just leave you with this question to chew on. Now that you're armed with this knowledge, now that you can look past the obvious fakeouts and start reading the subtle story told by the candle bodies, what new opportunities, what new insights do you think you're going to find waiting for you in your own charts? Hey, if you found this video insightful, do me a favor and hit that like button and subscribe to the channel. And seriously, if you have any questions at all, just drop them in the comments below and a real human will get back to you. Until the next one, good luck and safe trading.